Nike stock fell more than 18% on June 28, 2024. That wiped away more than $29 billion in market value in a single day. A few months earlier, Shopify stock dropped more than 16% in a single day, erasing more than $18 billion in total market. Yet, just a month before that, Tesla's stock skyrocketed 12% in a single day, creating $50 billion in market value. What do all these big one-day stock movements have in common? They were all market reactions to earnings reports. So if you're an investor, you must know how to find, read, and analyze them. In this video, I'll share the 3 simple steps to analyze any earnings report, even if you're a complete beginner. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing and investing in businesses for more than 20 years. So, what is an earnings report? Every public company in the US is required to file an up-to-date financial information with the Securities and Exchange Commission every 90 days. The shorter filings are called 10Qs, and the longer filing is called a 10K. These reports give investors a detailed look at the company's current financial condition, and they can sometimes cause massive one-day price swings in the company's stock. Now, these reports could look intimidating at first, but they can actually be quite easy to read and analyze once you know the 3 simple steps. To show you these steps, I'll walk through a made-up earnings report of a pretend company called Best Coffee Company. Now, step 1 of analyzing earnings report starts before the company even reports earnings, and that's to know the expectations that the company has on it. Now, each quarter, analysts who cover the stock estimate how much revenue and earnings per share a company is expected to generate in any given period. Now, some management team help out these analysts by issuing guidance, which is when they predict how much revenue or profits they're going to generate in a given period. If a company doesn't issue guidance, the analysts calculate these numbers themselves. Now, what happens is a number of analysts put out their estimates, and then the average of all those estimates are put together, and that is called the consensus number that a company is trying to hit. Now, you can easily find and track these numbers by using sites like FinChat, which tracks a company's revenue and earnings per share on a quarterly and annual basis. Another place that you can get them is on Yahoo Finance. If you click on the Analysis tab, you can actually scroll down and see the earnings estimates for both the quarter ahead in revenue and earnings. Now, knowing these estimates is incredibly important because the company's actual results will be compared to these expectations, and that can have a huge impact on the company's stock price. So let's pretend Best Coffee Company is about to report its Q1 earnings. The company's current expectation is that it's going to grow its revenue about 10% to $110 million, and that its earnings per share will also grow 10% to $1.10. This is kind of like a parent's placing expectations on their kids that they're going to get A's and B's on their report card. So these expectations are incredibly important to know. Now, once we know the expectations, that brings us to step 2, which is actually monitoring the company's results. Now, once a company actually reports its earnings, the next step is to compare the company's key numbers to Wall Street's expectations. Now, to find a company's actual earnings results, you can go directly to its investor relations page and click on the company's results, or you can use an aggregator like FinChat and track the company's results and slides right in there. Now, where the numbers are located in each company's report changes from company to company. Sometimes these numbers are right at the top of the report, other times they're hidden down below. But once you have these results in hand, the next step is to do a simple comparison. If the company's key numbers, namely revenue and earnings per share, exceed expectation, that's a great sign. That can often cause the stock price to rise. If the numbers simply meet or were worse below Wall Street's expectations, that's a bad sign, and this can cause the company's stock price to fall, sometimes drastically. To go back to our report card analogy, imagine a company expects their son or daughter to get A's and B's on their report card, and then they actually bring home a report card that is full of A's and A's pluses. They would be ecstatic. Conversely, if they were expected to get A's and B's on their report card, and their actual report card was filled with C's and D's, they would be extremely disappointed. Now, those headline numbers are certainly very important when analyzing a company's earnings report. However, the company also usually releases other information related to key metrics related to the company, business updates, and product results. So for our pretend company, let's pretend that their actual Q1 revenue came in at $111 million, and their actual earnings per share came in at $1.11. Both figures grew 11% year over year. Now, that compared very favorable to the 10% growth rate that was expected for revenue earnings per share. So in this case, we would say that Best Coffee Company beat its earnings expectations. That brings us to step 3, which is looking ahead. This is often the step that most confuses stock market investors. Some companies hold conference calls with investors where the management team provides additional commentary about what happened during the quarter and what they expect to happen in the quarter ahead. Some management teams even offer their investors guidance where they predict how much revenue or profits they're going to generate in the next quarter or year ahead. Now, this commentary and future guidance can have a massive impact on how Wall Street treats the report. Moreover, those same analysts are not only tracking what they expect the company to do this quarter, they're usually forecasting many years ahead, including the upcoming quarter, the upcoming year, and in many cases, future year periods. For example, for Best Coffee Company, let's pretend that in the next quarter that Wall Street was expecting 11% growth in revenue and 11% growth in earnings per share to $1.11. These are the new expectations that the company is going to have to meet and exceed in the next quarterly period. However, let's pretend that Best Coffee Company issued guidance for that next quarter that only called for 10% growth in revenue and 10% growth in earnings per share. That would actually compare unfavorable to the results that Wall Street had baked into the company's next earnings report. Now, as I hope I've shown so far, if you want to analyze a company's earnings, it's critical that you know how to find and read an income statement. But income statements can be very confusing, and not all companies lay them out the same way. To make things easier to understand, I created a free ebook that has a company's income statement along with all of the synonyms that a company might use when creating it. This same ebook has synonyms for all three of a company's financial report. If you want a free copy of this ebook, just visit longtermmindset.co/FSS ebook or click the link in the video description. So now that we have Best Coffee Company's earnings results, let's do a quick comparison. For the company's actual Q1 results, we would say that the company successfully beat earnings, providing $111 million in revenue when it was only expected to generate $110 million. However, for the company's forward guidance, we would say that the company missed the consensus estimate. It only forecasted 10% revenue growth when Wall Street really wanted 11%. Now, even though Best Coffee Company's actual results beat earnings expectations, if this was a real company, its stock would probably decline in wake of this earnings report. That's because markets are forward-looking and stock prices are impacted more by what's expected to happen in the near future than what actually happened in the recent past. This is exactly what caused Nike stock to plunge 18% in 2024. On the company's earnings call with investors, the management team let investors know that revenue is actually going to decline over the coming year. That downbeat forecast caused Wall Street to sell off the stock so drastically. Okay, now that you know how to analyze a company's earnings report, let's go through these 3 steps using Meta's first quarter earnings report in 2024 as an example. So in Q1 of 2024, Wall Street was expecting that Meta was going to grow its revenue by 26% to $36.2 billion, and that its earnings per share were going to come in at $4.32. I pulled these numbers from FinChat. So these were the numbers that Wall Street was expecting Meta to report in Q1 of 2024. Now, when the company actually reported earnings, its revenue actually grew 27% to $36.5 billion, and its earnings per share came in at $4.71, which grew 114%. So as you can see, both of these figures were above Wall Street's expectations, which was a very good sign for investors. So in regards to this earnings report, we would say that Meta exceeded expectations in Q1 of 2024. However, as I talked about earlier in this video, the company's future guidance actually matters tremendously when analyzing an earnings report. So let's see how the company did there. Well, if we look at the consensus estimates, Wall Street was expecting the company to grow its revenue by 20% in Q2 of 2024, $38.3 billion, and produce $4.26 in earnings per share, which would be growth of 43%. If we pull up the company's earnings report, we see that it actually issued second quarter 2024 revenue guidance to be the range of $36.5 to $39 billion. Now, when management teams issue a range of guidance, the common thing to do is to take the middle of those numbers and use that as your estimate. So the midpoint of that range indicates that Facebook's management team was guiding for $37.75 billion in revenue in Q2 of 2024. Now, that only represents growth of 18%. Moreover, if you read the rest of the guidance, they actually don't issue guidance on an earnings per share basis. Now, in this case, even though Meta exceeded its earnings expectations for the quarter, since its guidance was below what Wall Street was expecting, Wall Street sold off its stock by 12% in the wake of this report, which wiped away $130 billion in market value. There is a lot of pressure on management teams to exceed their key figures when they're reporting earnings, both in the current period as well as the next period. And company stocks can sometimes be punished severely if the company fails to meet Wall Street's expectations. Now, importantly, everything that we've covered so far really only matters if you're trying to game the company's earnings report and trade on it from a quarter-to-quarter period. Now, how should you view these reports if you're a long-term investor? Should you fret about a company meeting or exceeding its revenue and earnings per share guidance? We don't think so. Instead, if you're an investor, we think there's a key question that you need to keep in mind when you're analyzing an earnings report, and that is this: is the core thesis for owning that company still intact? That is the overriding question that you should be trying to answer when you're looking at a company's earnings report. Now, to answer that question, the revenue and the earnings certainly matter, but there's a number of other things that you should focus on too. That includes a company's actual growth rate, company's key reporting metrics. You should be looking for new opportunities that are on the horizon, new threats that are on the horizon, a direction of the company's moat, and most importantly, from stock perspective, the company's valuation. If you've seen any of the earnings review that we do on this channel, you know that we end each earnings report with an overview of the company's thesis. We give you the 4 key metrics that we're going to be watching when the company analyzes earnings, the direction of the company's moat, and whether or not we think the thesis is on track. If the company's thesis is on track, the next step is to value the company using whatever valuation metric makes the most sense given where the company is on the business growth cycle. Now, if that kind of analysis interests you, subscribe to our channel because we cover the earnings reports of about 15 to 20 company stocks. Now, I hope that this video was useful. If it was, let us know in the comment section below. And if you want to keep on learning for here, I highly recommend you watch this video next.